expenditure approach. So with the income approach, you're just trying to find out what is the total income that is made within the country's borders that year. This includes the income of foreigners and the income of citizens of the nation. You want to see the total income, because according to the circular flow diagram, income that is earned is equal to the expenditure, money that is spent, and it's also equal to the output. So here we're trying to see what is the total income earned within our borders, okay, from foreign companies and also domestic companies. Okay, then the expenditure approach is what is the total expenditure within the economy. So these two usually have to be equal to each other. All right, so we have a question here. Right, with this information in, we have to calculate the GDP using the expenditure approach and the income approach. Right, so if we use the expenditure approach, first we have to look at where is the expenditure in our formation here. Right, we have household consumption. Right, we've got net exports. Okay, when you subtract your exports minus your imports, if it's a positive number, it means you're exporting more. Right, we've got investment here by businesses, and we have government spending. So with the expenditure approach, it's consumption plus investment plus government spending plus exports minus imports. So I've already got the calculations here. All right, consumption by the citizens within the nation, as we can see on our table, 304. Government's investment expenditure, spending by businesses, 124. Government spending, 156. Net exports, 18. So we just add these four things. Right, so 304 plus 124 plus 156 plus 18, we get 602 watt. Alright, now we have to use the income approach. Okay, so with the income approach, remember, it's the profits earned by entrepreneurs and businesses, the rent earned by landowners, the interest earned by people who have saved in the bank. All right, they've saved money in the bank uses that money to borrow to businesses that buy capital. Okay, and those companies will pay the bank interest, and also you are going to also receive an interest for keeping your money in the bank. And the wages, this is the labor. Right, then we need to add depreciation and our sales taxes plus our net foreign factor income. The net foreign factor income, all right, this is just basically the difference between the money that is earned by Zambian citizens and businesses abroad versus the money that is earned by foreign citizens and businesses within Zambia. Okay, this can include salaries. This can also include profits. For example, if Trade Kings has a company in Malawi, all right, that the profit that company is making is coming back to Zambia. Even Chinese businesses, they are set up here in Zambia. The profit that they make, they remit it back to China. All right, even dividends owned in foreign countries. Right, if you're a Zambian who's earning dividends from a foreign country like America, those dividends that you're receiving is part of the national part of the income. Okay, yes. So basically we're just looking at all forms of income here. Okay, so we've got interest income, net foreign factor income. So since it's positive, so our citizens are earning more abroad than the foreigners who are earning here in Zambia. Okay, for this example here, we have rent, indirect business taxes, this is income earned by the government, corporate profits, depreciation, and wages. Alright, so if we add profits 200 plus 75 plus 150 plus 67, then we add depreciation plus our sales tax and the net foreign factor income, we get GDP of 602 what? So this is the income that is earned within Zambia. Alright, it's the income that is earned within Zambia.